Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Joe Smazal. He is a multifamily broker in Chicagoland who has personally sold over 240 properties comprised of over 5,300 units, valued at over $940 million, focusing primarily on apartment buildings worth over $2 million. So thank you so much for being on the show today, Joe.
Pleasure to be here, man. Thanks for the invite.
So you've been a broker for many years. Can you tell us a little bit prior to becoming a real estate broker, a little bit about yourself, both personally and professionally, and what kind of drove you into real estate?
Yeah, sure. I grew up in Iowa. My dad started an advertising business, and then he was traveling a lot and ended up buying and operating a small business in Davenport, Iowa, and Bettendorf, Iowa is where I grew up. But I bring it up because it taught me a lot about being an entrepreneur and the sacrifices that you have to take. And, you know, he did that so he could be around the family more, but there was still a lot of stressful times and long hours for him. And, you know, he taught himself a totally new business. So I learned a lot from him growing up, just observing what it takes to provide for a family. And then my mom, you know, at the time she was a stay-at-home mom, but she was a seamstress as well. So she did like alterations and stuff for clothing and wedding dresses and that sort of thing. And she was hustling too. You know, every night, you know, when we were winding down or after we went to bed or whatever, she was like in the sewing room working. So, you know, observed a lot from her as well about, you know, the sacrifices that she made to be there for us and also, you know, contribute to our family's livelihood. So anyway, I went to the University of Iowa. I didn't really even think about going anywhere else. It was like an hour from home. It was a reasonable price. Some of my friends were going. It felt like a cool place to go to school. I was an okay student, like B's, you know, and wasn't really my focus. Like schoolwork wasn't my focus of school, I felt like, and that carried through to Iowa, but I had an awesome time there. And then in a totally unoriginal series of events, I moved from a Big Ten school to Chicago, which is kind of it's a beacon for, you know, ambitious people from the Midwest. So I moved to Chicago in 2009. It's a crummy time to get a job. Took a job. I thought I wanted to do medical sales because I just didn't know. It felt like I don't even know why I thought that. It just felt like a cool job. Felt like a job that, you know, you could be ambitious in and be rewarded for hard work. But nobody really wanted to hire somebody in medical sales that didn't have any experience. So I ended up getting a job as like kind of they called it an account manager. It was like a hybrid between a sales guy and basically like a delivery guy for a specialty hospital bed company. And the guy was an incredible entrepreneur. He was an inventor, and I worked directly with the CEO, who gave me a lot of opportunity. He just saw a lot of hustle in me. I was ambitious. I was eager to prove myself, and I was excited to be working too. I like working more than I liked studying. So I liked the idea of having an opportunity to make money and advance in a career. So I think he saw that in me, and you know, it gave me a lot of opportunity to do kind of presentations and travel around the country. And then a few years after doing that, it just like, you know, being a salesperson in medical sales is kind of like a delicate dance where, you know, you have a job to do and you have a role, but it's also just, you're in the hospital or you're in the nursing home a lot, and it's just kind of a grind. And it just overall didn't feel like really what I wanted to do like in 10 years. And I guess I had the foresight to see that if it wasn't something I was going to do kind of forever, I saw myself doing for in the long run, it was easier to pivot back then, before I was, you know, married and had kids and stuff. So that led me to explore getting into real estate.
Interesting. And, you know, within real estate, with the firm you're working with now, but you worked at another firm prior, I believe, how did you kind of narrow your focus down to what your asset class you're focusing on within real estate? Because I mean, real estate there's a dozen different asset classes that you can focus on. And I find the most successful people, especially brokers within the industry, have a very narrow focus of what they work on.
Yeah. The truth is I got lucky. I didn't really know much about real estate when I got into real estate and I didn't even know much about Chicago. Now I drive around the city and I think I know every street. But I didn't know much about it. But I ended up interviewing with a few potential mentors at Marcus and Millichap, which is a big national firm that a lot of people, there's a lot of great brokers that stay there for a long time. A lot of people learn there and some stay, some go. But I just, there were 3 different mentors that I ended up talking to. And the one that I felt like I clicked with the most did apartment buildings. There's a guy named Jamie Clow, and he was it just felt like kind of a good timing for both of us for me to get involved. And this is in 2011. So, that a lot of the gusto had been taken out of the brokerage community for the prior couple of years. Some people had been kind of weeded out because it was a tough time in the market, and some like senior guys just used it as a time to retire because it was tough. And, it just ended up being a really good time for me to ramp up, just like if you were an investor and bought something during that period, being a broker who was working really hard at that time, you could get ahead because a lot of the brokerage community was kind of tired and market conditions were tough, but I didn't know any better. So that was kind of a tangent, but to answer your question, I kind of lucked out to get into the apartment business. Now it's something I'm an expert in and I specialize in, and I, buy little apartment buildings to practice what I preach. And I think that it's a great vehicle for, real estate investment long term, and it's just something I know and have always understood. It just kind of clicked with me early.
Yeah, it's one of those things. I bought my first apartment building or multifamily property in 06, and I remember buying it again at the end of 08, and it was, like you say, people were weeded out. It was, 08, 09, there's people that were full-time in 06, beginning of 07, completely out of the business, completely different industries are in, nothing to do with real estate. The people I found that were full-time in real estate that made it through in 09 and 2010, they were like serious, the true people that had built a business, a client list that they were working with. And I had one real estate agent I was working with, and, he had built over many years a business, but while so many of us got weeded out, he was still around because he had a true business. The other ones were kind of just like, flying by the seat of their pants and picking up what was, you know what I mean?
Yeah, I think that there's a big difference in brokerage for people that approach their brokerage practice as a business, and people who approach it as, they're kind of chasing deals. And if you're chasing deals, you're very much at the mercy of market conditions, and you can find a few deals that click and, make a good living doing it. But I generally think that that's fleeting. I think, I'm approaching it as a very long-term business. So when market conditions aren't as favorable, you double down on, kind of your front of the pipeline stuff, and make sure that you're still in front of your clients, doing the right things, and advising on, their long-term investment decisions. I think when things are a little bit rocky is when good brokers and good investors, end up getting ahead more than when things are good.
That makes sense.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
For investors looking to purchase apartment buildings in Chicago or greater Chicago, what are some of the top considerations that they should be aware of when entering this market, this MSA?
If it's somebody that's from outside of the city, I think, starting with a geographic focus, I think is a good start. It's a city of neighborhoods. Every neighborhood ends up being a little bit different, has different, demand drivers, tenant preferences, operational considerations. So I think really knowing what type of submarket that you want to be in is a good place to start, because, operating in Lincoln Park can be a lot different than operating in South Shore. And both of those neighborhoods have reasons to invest, but they end up just being kind of different considerations. So I think starting there, within the neighborhoods, I think understanding even who the aldermen or alderwomen are, and just the different kind of nuances that come with who the local politicians are in those areas and how that can influence a particular ward, I think is kind of the next level. But I'll stop there and not ramble too much.
No, that makes sense. As being, super diligent and super informed on where you're buying. And I think that's very, very important. When I started buying apartment buildings, or just small multifamily properties, it was like for the first 6 years I self-managed them, and I had one area of this city in Connecticut that I was living in and that I would focus on. And if you really saw a picture, if I saw a picture on Craigslist or something of a property, I have an idea of where it was, because you just knew the street so well and you kind of knew where you're staying, and you're like, that's kind of like a little iffy over there for me. Don't really like that too much. But if I ever spoke to a broker or something like that, you could narrow it down to you know what I mean? Exactly what works, and then what doesn't work square footage wise, the whole 9 yards,
Yeah. I mean, and then there are levels to it. Once you get into finding what type of neighborhood you're looking for, then it's block by block, street by street, and then you're really kind of fine tuning what type of property you want to own. I have a bias towards advising people to own, to buy what they want to own for the longer term, because I just think generally if you're buying apartment buildings, you end up faring better if you've got kind of a longer hold period in mind. You're less at the mercy of market conditions. So, buy the type of real estate you want to own for a while.
Yeah, that's great advice. I think new investors get caught up on getting involved with short-term plays, I think, with multifamily and getting short-term debt. Whereas if they just got longer-term debt, it was a longer investment horizon, they'd probably fare much better, I think. Because,
Yeah, I think just LinkedIn and the social media world in general, especially the last few years, have influenced that a little bit. You go on your news feed or whatever they call it on LinkedIn, and it's just people talking about their IRR or their, equity multiple after a couple of years. And it's great if it goes that way. But, I just think generally approaching real estate investing as a longer term thing. And, if you're investing in real estate, I kind of like to look at it as operating a business as opposed to just making a passive investment. Even if you're doing it with somebody else or you're, you have the third party managed, I think it's better to kind of asset manage those investments and look at it as its own kind of living, breathing business, rather than, investment buying a stock or something like that.
Yeah, you're definitely buying a business with whatever multifamily property you buy. You're buying a business. I mean, that's the only way you can really put it.
Yeah, very much so. There's just and I think if you go in with that mindset, just like approaching brokerage as a business, going in with buying an apartment building as a business, changes your perspective a little bit. And I think it, then you make sure that you allocate, time the way that a business should use its bandwidth, and in marketing and asset management. It ends up being a different perspective. And I think, aligns the priorities of owning an apartment a little bit better than thinking about it as an investment.
When you're speaking to a potential client, I mean, how do you recognize serious investors from tire kickers, Joe?
I think the first thing that came to mind when you said that was how quickly somebody talks about a cap rate. If they lead with, I want to buy a 6 cap, 7 cap, 8 cap, whatever, then I think that there's probably some more education to do. Not necessarily that they're not serious, but that, the cap rate on the type of apartment buildings I sell in particular, kind of mid-size apartment buildings, and your cap rate, my cap rate, the next buyer's cap rate, the lender's cap rate, the appraiser's cap rate, everybody kind of looks at it differently. And your business plan going forward is much more impactful for the success of the investment than, what the seller's cap rate is based on trailing financials. So I think understanding how quickly a cap rate can move based on how you're underwriting a deal is really critical in apartment investing. And, a lot of the clients I do a lot of business with, they'll look at the seller's trailing financials to get a sense. Some don't, but, they're really looking at a rent roll, but more than that, they're looking at the layout of the building, the finishes of the units, what they're going to spend, if anything, what they're going to do going forward. And they're much more concerned about what their cap rate is on a going forward pro forma than they are, the seller's historical operations. So the cap rate conversation is one that I think is generally pretty indicative of where we are and kind of the, I don't dismiss it as them being not serious, but I think if they're quoting those early, it's generally some education involved.
Yeah, no, that makes sense. Can you, how cap rates are really found? How people establish it, right? Like you said, there's all different parties and everybody has a different thinking of what it might be. When someone asks you, what would you say as how someone would locate the cap rate for an area? Is it looking at my past deals that are similar in that area? Or, what do you say? What is your answer to that?
Yeah, I think the most important thing, however you end up underwriting it, is to make sure that it's apples to apples. So when we're looking at sales comps, we'll do our best to get rent and expense information. And investors, when we present an offering memorandum, there's an expectation of some consistency in the way that they're presented. So, we're going to underwrite, underwrite two deals. There's nuances to them, but basically with a lot of the same kind of like rows on the Excel. And obviously if something has an elevator versus not having it, there's nuance. I'm not trying to like oversimplify it, but we want to make sure that there's vacancy factors, that there's management fees, that there's janitorial, that there's leasing commissions, that there's a budget for repairs and maintenance, cleaning and turnover, marketing, all these things. So it could move a cap rate 100 basis points. So to answer your question, I think the most important thing is to put the buildings and their operations kind of in the same consistent template, and then try to look at cap rate as apples to apples as possible in the underwriting.
I think the comparables, when people ask me, I think comparables are one of the things I regularly, let's say, see that are off, right? When people are telling me a comparable is, miles away, or they're telling me, oh, it's the same year built or it's close to it, but this has 12 units and that has 120, completely different amenities. You know what I mean? Like you said, the elevator, like all these things, and it makes it where, we have technology, which I think people stand behind, but walking the comparables and like mystery shopping them and to your subject property of what you're doing, there's really, it really comes down to even driving the area. It really comes down to a lot of stuff you have to do kind of boots on the ground, because you can look on, I can look on Google Maps and say, here, this is the building and there's a Starbucks here and it's gray in there. But between these different things, I don't see it. There's a train track or there's a brook, There's some body of water. And you may really see it a little bit, but it's like, it changes the neighborhoods. Like, when you're driving, like, whoa, what just happened? Where am I now?
Massively so. And I think in addition to knowing the nuances of a neighborhood and understanding the location, it's like, just as two examples, we could sell a deal for a 4 cap if the rents are 20% below market. And then, we could see a deal that it could have been listed on CoStar or whatever as like an 8 cap, but maybe the taxes are massively underassessed and there's a new assessment out that's going to increase the taxes. So it's so much more to the story of that particular deal, and then adjusting for those things to be able to kind of quote a cap rate and to have a target. But I think one of the toughest conversations that I have really regularly is when appraisers call me asking for cap rate information, because it just is, it's tough to quote them on these, like we talked about earlier, kind of these living, breathing businesses where it can change pretty dramatically.
It also depends on, who's buying it too. I've sold apartment buildings before that I thought the cap rate was super low. I was like, I would never pay this. But person owns 4 other apartment buildings within a stone's throw. So for him, he's cutting that management down over there on that side, a person that's just new to the neighborhood can't do that. You know what I mean? So he has an advantage.
Exactly. Yeah. I mean, you can have some efficiencies of scale, or you can parlay your staffing from other properties. And there's also, I think people get so caught up in like what cap rate makes sense to buy. And there's just a lot of reasons to acquire real estate and to acquire apartment buildings, like the tax benefits, the hold period. A lot of people in Chicago are very kind of territorial of inventory in a particular neighborhood of the city. So if a 50-unit apartment building comes in the market in Ravenswood or Lincoln Park, where there's a real scarcity in that type of product, the generational hold buyers are going to pay up for that, and they're not concerned what the cap rate is on a year one basis. And they're not reckless, and it's quite the opposite. They just know that they want to own something for 20 plus years, and in 20 years their experience tells them that the building is going to be worth considerably more, and they'll be happy that they bought it, and they've got global cash flow elsewhere in their portfolio. So I think people like sometimes make these determinations on like what cap rate is market, and then anything that you buy that's above that cap rate is a good buy, and anything you buy below that cap rate is not. And it's just so much more particular to the investor than that.
It's also the cap rate game. You start going higher, neighborhoods might start becoming less ideal, let's just say. So it takes someone that knows those intimately. My dad had been a multifamily investor since like 1984, and I never heard him even mention cap rate. And he'd meet up with like these old school kind of investors, and they'd buy properties on the back of napkins, stuff you do back in the 80s and 90s, and I never heard my dad say cap rate once. You know what I mean? It was like back of the napkin math, and they were just like, true cash flow investors, right? Kind of thing.
Yeah. Those are some of my best clients still. That I could send them a deal, and they could drive by it and on the steering wheel of their car determine what the property's worth for them. It's just it's not for everybody, but that's like that old school mentality. I think like if a deal works on a napkin, it's probably a good deal. And if it doesn't, if you're really having to finesse and excel, maybe not.
Yeah. If you got to really sharpen that pencil or get on the 12-tab Excel spreadsheet, maybe it's not so much a deal, right? So, yeah. So from the other side of it, I mean, when you're talking to new investors, what are some of the things that maybe they stand out? You know what I mean? They stand out from other investors. What do they do that might put them ahead of other investors? And maybe you get a new listing that comes in that you pass to them first before other ones.
Yeah. I think communication is a big part of it, giving feedback, on the front end, being fairly specific with acquisition criteria helps, not being so specific that property is a needle in the haystack, but, being specific enough where I know what they're shopping for. And then, as, I'm kind of opening up the deal flow, understanding if a deal is a pass, understanding maybe just a couple quick bullets on what wasn't a fit about it. That really helps tailor what I send to them, in the future. And then, through the kind of continuum of chasing a deal, I think not being shy about sharing qualifications, track record information. If it's somebody without a long track record of acquiring buildings, sharing a little bit about their process and source equity and anticipated lender that they're working with. Some people, if they're cagey about those things, it's kind of a red flag. Not that, the first time I talk to someone, I'm like, send me proof of funds. It's not like that. It's just when the time comes and we're presenting an offer, it behooves the investor for the broker to know who they're representing so that they could tell, if you're the seller on a deal, Charles, and I say, hey, I'm representing Bob. He's new to this submarket. He owns a handful of other buildings in Florida. Similarly, he's made relationships with local managers. Here are the two banks that he's going to run the deal by. It's a much different conversation than like sending an LOI from somebody or a PSA from somebody that is like an unknown commodity in the market. So I think sharing qualifications so that the broker can present the offer in the best light possible goes a long way.
Yeah, no, very, very, very well said. I think one of the things I used to be is mistakes I used to make was that I wouldn't respond as fast as I should have been to brokers with deals. And over like the last 5 or 7 years, I have a rule of like, no matter what they send me, I mean, unless it's like some blanket spam to some place I'm not buying, but if it's like, someone send me one-on-one, I review it and I get back to them no matter what within like, usually a couple hours, no more than 24 hours, and give them feedback of I'm interested or I'm not. And I always get a response thanking me for that.
It is a good move. And I think it also, because brokers and even sellers, because it kind of gets to them eventually if we get far enough along with it. But like, it is an indication of how you're going to be to transact with, so if you're responsive when you're vetting deals, you're going to be responsive when we're working on a deal. If you're just direct and honest, you're going to be direct and honest when we're transacting together too. So it's just like, and for brokers, we're kind of auditioning for you too. So I want to be communicative. I want to be direct. I want to be a good kind of conduit for inventory for you, because when we're really, my best clients, we're doing a lot of business. We're building our businesses together, so it really is, not to be cheesy about it, it really does turn into a partnership. So the beginning of establishing kind of the expectations for that partnership are really impactful. And then, when brokers trust that that you do what you say you do, and you're communicative and you're fair and all these things, and you get the best deal flow. That's just how it goes.
Interesting. Yeah. I think one thing, I have a friend of mine that is a hard money lender, and he's like, before we even get to a loan, if I'm having issues tracking this person down, it's like a no-go. I'm just like done with it, because if they haven't given them the money yet, why doesn't when I give them the money? You know what I mean? I'm never going to hear back from them.
Man, I think, I don't know if it's just like a little bit more experience in doing this, or like, it's more of a sign of the times, but like just dealing with people that are nice people to deal with is so, it just improves efficiency of your day, improves your mood. And then you're also, that you're representing somebody who's just like a fair person to deal with, and so like it ends up being a reflection of the broker, how the buyer performs, the seller, it's just the overall experience is going to be much more positive. So like, being even keel, being direct, and just being like a normal person, I feel like goes a long way these days.
Pretty straightforward. Yeah. So Joey, it's a very competitive market being a real estate broker, especially in multifamily. I mean, there's a lot of brokers out there, and there's a lot of national firms out there that you guys compete with. What would you consider is your competitive advantage over other brokers in your space?
I have, I don't know that there's a lot of secret sauce in it. I don't know that I'm going to give a real exciting answer, other than for the last, 13 and a half years, I've been really consistently focused on selling mid-sized apartment buildings on the north side of the city. And so the byproduct of that is you've got all these relationships, you've got a track record, and all just compounds. So it gets like easier over time, because, you have a reputation in the market, and then you have all these relationships. And I think like when you look back at that, you're like, man, that really kind of snowballed into something. I don't really I haven't taken my eye off the ball in terms of focusing on a different geographic area or a different size deal, or, taking much time away from with my investments. Those are all they're small deals that are easy to manage. My wife and I do it together. So it's just I think doubling down on my focus has really been probably the biggest differentiator from competition. And then as a broker, it can be kind of a grind. So just sticking with it through different cycles, and making sure that you're always feeding the front of the pipeline. I think that I treat people well along the way too. I really don't want to burn bridges. I'll be honest with somebody, even if it's not convenient to be honest with them. And I think that goes a long way. It's a small world, Yeah.
No, that's a great answer. I think the focus is a super important thing, and you see it in real estate. You see it with different people that might, investors that might change their asset classes they're focusing on, and they're like, "Oh, we're not doing this now. We're doing this now, and we're not, this is the big thing we're doing now, and it's completely changing." It's kind of like that shiny object type thing, and I don't know. It brings you down as if compared to someone that's been doing something for decades, and this is my specialty. Like you said, you just narrowed it down exactly. These size properties, this side of the city. But for overall these decades of what you're working with investors, multifamily investors mainly, what are common mistakes, as we kind of wrap up here, you see them make?
I think we touched on it earlier, but I think I think not treating it as an operating business is or not understanding the operations enough. I think some people, you were talking about a little bit earlier, kind of like looking at an area that, if you look at a deal, right away whether it's going to work for you. But if it's a new area to you and you don't establish enough kind of baseline knowledge, you can think that operating an apartment building in South Florida is the same as operating an apartment building in Chicago, and just understanding the different considerations on the front end and understanding how the property is going to operate, I think is the most important way to evaluate kind of on the front end whether an investment is going to work out well. Because it just all comes down to the operations. And then, I guess when a guy that I'm friendly with, who's a client too, Drew Brenneman, he said something that resonated with me that just popped in my head when you mentioned that question, or when you asked that question, was kind of marrying the debt with your investment objective and with your anticipated hold period. So, flexibility on prepayment if you intend to sell it sooner. And then just kind of trying to have maybe a maturity jive a little bit more with your anticipated hold period. We've seen debt be a really, really important piece of the puzzle lately. And, there's been some properties that operate in Chicago incredibly well, and you're seeing strong rent growth, but they have a maturity at an inconvenient time, and it can derail an investment entirely. So I think doing your best to put appropriate leverage, and not only leverage amounts, but just like the source of the debt, flexibility if there is going to be any, I think goes a long way also.
Yeah. Not being able to refinance a good deal is definitely a major problem and a bad day, right?
Yeah, totally.
So Joe, how can our listeners learn more about you and your business?
Yeah, I'm pretty easy to get in touch with. I don't think I'd be a very good broker if I wasn't, accessible. I usually post my like real estate type stuff on LinkedIn. My Instagram is pretty much my kids and like maybe a golf course that I'm occasionally playing. So like LinkedIn is probably the best way to like just kind of stay in touch. And then from there, I'm easy to get in touch with if you're interested in multifamily investing in Chicago. I feel like it's my job to be a resource. And I'm really active in the space, and I like meeting new people because I think it makes me really effective at what I do, to not only know the real established people, but know the people who are going to be new players in the market. So, if you reach out, like you said, as long as it's not kind of like a spammy LinkedIn message that we get all the time, I'm going to respond.
Oh yeah. Spammy LinkedIn messages. I know those. It makes me not want to accept any messages now, because then you're like, oh wow, 5 messages in one.
Dude. Yeah. They've gotten bad. Like I can tell by the first one, whether I just mute the conversation or whether it's going to be something substantive. But it doesn't seem to discourage the people that are doing that. You sometimes look on the thread and it's like 15 messages.
It is what it is. Well, thank you so much for coming on today. Joe, looking forward to connecting with you here in the near future, and have a great rest of your day.
Yeah, thanks again. It was fun.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.